Hello, and welcome to the Logistics Management Podcast Series. My name is Jeff Berman. I'm Group News Editor for Logistics Management Magazine and the Peerless Media Supply Chain Group. Today, I'd like to say hello and welcome Keith Prather to our podcast. Keith serves as Managing Director for Armada Corporate Intelligence. Keith is a managing director and co-founder of Armada Corporate Intelligence, and over his 24 years with the company, he has consulted Fortune 500 and companies of all sizes, providing corporate intelligence, economic forecasting, and insights on changing global dynamics, geopolitics, supply chain issues, and other factors that affect the corporate operating environment. Keith has spent 24 years working with clients in the transportation and global supply chain sector, providing strategic support and insights on the global operating environment. He's also a former CFO and is the chief editor for the flagship, an officer of the Watch Report, read by more than 18,000 corporate executives weekly. He and co-founder Chris Kuehl present keynotes on the economy at more than 120 events per year. Hey, Keith, welcome to the podcast.
Hey, Jeff, I'm pleased to be here. I'm excited.
Yeah, absolutely. And the timing couldn't be better, Keith. As we have been talking about, there's never a dull moment in supply chain, freight transportation, and logistics these days. So just to sort of kick things off, Keith, why don't we take a look at how you're viewing the current state of the freight economy? And I know that's kind of an all-encompassing thing when we think about all the things that factor into it, whether it's GDP, retail sales, inflation, manufacturing data, freight volumes and tonnage, et cetera. There's a lot to unpeel there, if you will. So why don't we start with that, and then we can drill down to some other things.
Sounds great. Sounds great. Overall, Jeff, last year, and I know you've heard me speak several times, and I really have been watching the inventory destocking process that's been ongoing for the last 2 years. And coming out of 2024, we were growing pretty well. The economy was growing somewhere around 2.6%, had a pretty good year overall. Now we know that a lot of it was government spending and backstraps there. But we'll leave that aside for a moment, and we'll just say that coming out of 2024, we knew that inventories were balanced, and we thought it'd be a really good freight year. And we actually started the year off pretty strong. We had some good solid signals in January. We're also getting some pretty decent signals in February, spilling over into March. But now we're kind of wondering how much of that was really, companies trying to get ahead of tariff risk, trying to
Hmm.
get ahead of what was, risk of a port strike in January, and that maybe there's a little bit of pulled forward freight activity that would have been scheduled for Q2. Maybe we're getting a little bit of that in Q1. Then we throw on top of that all the volatility that we're going through right now, and it has created a very challenging, dynamic freight environment overall. Uh,
Yeah, absolutely. Um, it, it's interesting too. I mean, we look at the most recent inflation reading. I mean, everything seems to indicate it's kind of remains in that 3% range. 2.8, 3. I think the last reading was 2.8, coming off of 3, the previous reading in January. How do you sort of view the current state of that? Do you think that's? I know the Fed wants things to get down to 2%, obviously. Do you think we're sort of in that kind of high twos, low threes range for the foreseeable future until we get more clarity on tariff actions and things along those lines?
yeah, based on the latest analysis, and literally as of today, we think that current tariff activity could add about zero point 0.3 percentage points to inflation at a macro level. Okay, so some industries are going to experience a much higher, more aggressive inflation rate, but the overall macro economy should be moving somewhere around 2.8, 2.9% through the end of the year.
Okay.
When we look at average inflation has been running somewhere around 2.6%. So, trending in the right direction. The Federal Reserve is going to continue to loosen up whether we hit that 2% rate or not. So, as long as it's down in the 2.4 to 2.5% range, they're going to feel like they can trim again this year. They're forecasting still we might get 2 quarter point cuts. Depending on what happens with unemployment, you could see that move a little bit quicker.
Right. And then as we know, the Fed paused activity last I believe was it last week, I think. I think it was.
It
But
was, yes.
yeah. So, I mean, and they indicated it seems to be kind of a wait and see approach, which is makes sense. So let's shift gears over to everyone's favorite topic these days, Keith, and that would simply be tariffs. As we saw yesterday and in the news cycle into today, 25% tariff on automotive imports is taking effect. I mean, it's definitely going to be interesting to see what transpires resultant to that. But on a surface level, because we're just getting this news, how do you sort of view the impact of auto tariffs and what could be some of the subsequent effects of it?
Yeah, well, beyond all of us hyperventilating right now, trying to keep up with everything that's happening with tariffs, because we've got the April 2nd deadline with reciprocal tariffs coming, but the first automotive impact, it's pretty significant because 50% of the vehicles that we sell in the United States are imported. So
Yeah.
50% of the vehicles are going to have at least a 25% risk against them, but at the same time, 60% of our domestic components that we use for assembly also have exposure to international markets. So Cox Automotive is thinking there should be about a 30% decrease in North American output this year as companies just try to grapple with the kinds of changes that the industry is going to be going through. So near term, we see a lot of pressure in the industry. Longer term, obviously things stretch out a little bit. We see differences in distribution patterns, for freight, and we kind of see the market adjust. But we're still 2 or 3 really aggressive quarters away from those automotive supply chains really making those adjustments and being able to compensate for the tariff.
Okay. Okay. And then you had just mentioned April 2nd. This has been telegraphed for a while now that it's going to be a pretty big day, especially in regards to the aforementioned reciprocal tariffs. How do you sort of, I mean, now the announcement is coming, it's coming real soon. How do you sort of view what we may be in store for? And especially from a supply chain slash shipper preparation perspective as well. Given that we don't know all the details just yet, but what could we be looking at? What how do we think about that?
Yeah, so I've really stepped back from the ledge a little bit, in the last couple of days. This morning was a great example. Vietnam has announced that it's going to probably look at reducing its tariffs on U.S. goods because it would be one of the countries that would be targeted for reciprocal tariffs. Some of our best trading partners, like South Korea, for instance, we have a almost a 10-point trade deficit right now based on the application of our tariffs and the application of their tariffs. And so we have some big partners out there that are at a big risk. European Union the same way. But what we're seeing in a lot of those trading partners that they're willing to come down and sort of meet the United States halfway. And the president has even said just in the last few days that the reciprocal tariffs may feel more like a negotiation, or that he may find some leniency, as he said, in those negotiations. And so I have a feeling, but at the end of the day, once we finally see, when the smoke clears and we see what those final policies look like and the negotiations are over, that it may not be as dramatic as, say, the 25% tariffs on automotives.
Okay.
I have a feeling we're going to look back, and from a supply chain perspective, the automotive tariff may be a bigger deal than the reciprocal tariffs, but
Okay.
subject to change, right?
Yeah, absolutely. And just because we have such a heavy supply chain focus, obviously, when we look at, the uncertainty and sort of coupled with the impact of these ongoing tariff actions, in terms of what it means for freight flows, and I'm specifically thinking about imports and inventories, Keith. You had just addressed inventories a few moments ago. Because there's been a lot of that pull forward activity. You see the subsequent impacts potentially on things like inventory carrying cost, warehousing expenses as well. It's just kind of what shippers and 3PLs, et cetera, are the world that they're all living in right now. So, I mean, there's also talk that the pull forward could be ceasing sooner than expected too. So I mean, there's a lot there. I don't mean to have such a wordy question, if you will, but how do you sort of think about those types of things when we think about freight flows, inventory carrying cost, warehousing impact, etc.?
Yeah, no, I mean the wordiness. Don't worry about it because that's the world we're all living in right now. There's a lot of there's a lot of yeah buts. Yeah, but what about this? What about that? We're just going
Of
through,
course.
right. Yeah. So inventory carrying costs right now, because the cost of capital is still high, that is a factor. The one thing about supply chain management these days is that we've invested so much in technology as an industry that now we can kind of quickly calculate and weigh the differences between freight rates maybe from a maritime perspective that are reducing versus currency exchange rates, the impact of a tariff versus inventory carrying costs. And I think a lot of supply chain managers are making those dynamic decisions based on what their outlooks look like, right? So if they feel like they've got a strong demand outlook for the first half of the year, if they're in one of those industries like some of the consumer spending categories and consumer staples, for instance, in retail, which are still doing really well, and we see no pullback, they're going to continue to really measure their supply chain, and we're going to see big differences in the way different supply chain managers address and approach tariffs based on their individual situation. So what we're seeing, and I'm saying all that to say that when we look at it from a macro perspective, we look at it just from the US sitting at 100,000 feet looking down, we don't see overbuilding of inventories, right? We're not going back into a 2022 scenario where we're seeing warehouses full and companies overreacting, and we see the supply chain getting out of balance based on current data, right? Based on the data that we have on
Mhm.
inventories at the moment. So again, it's interesting because thank goodness for technology at the moment, because whether it's AI or whatever they're using, because we have that ability to digest, to sort of adjust on a dynamic basis. And I think you're right. Your intuition is exactly right that you feel some thinking that, okay, we took our shot. Maybe we got a few expedited air cargo shipments, a few pallets in advance to build a little bit of a buffer against tariffs. But we're deep enough now in the process. Let's just wait for the smoke to clear, and then we'll go figure out how much we need to order on the backside of this at that higher price, and then we'll just make the adjustments when those items come in. That kind of feels like we're transitioning into that phase of it now where the companies are adjusting to the higher prices, and they're just going to kind of grin and bear it.
Yeah, I mean, nobody wants to go back to that 2022 scenario that you just mentioned, amid I guess the early exit of the pandemic when the bloated inventories were sort of the conversation of the day, right?
Right, absolutely, absolutely. Yeah, led to a 24-month, basically a freight recession.
Yeah,
And
no.
yeah,
You had just mentioned the term demand pullback, and I thought that was interesting because I did come across a recent CNBC poll of CFOs that found that more than half are anticipating a second half recession due to what was called, and I'm quoting here, a whipsaw trade policy and the related task of insurgent inflation and lower consumer demand. Obviously, when we look at data like this, it can be open to interpretation, Keith. But I mean, how do you view the potential prospects of some type of recession over the second half of this year? Is it too early to tell, or some of the tea leaves pointing that way, if you will?
it is too early to tell, and I'll tell you the reason why. Nothing that has been done thus far has been done through an act of Congress. And for better or worse, all of the actions that have been taken so far that have slowed down economic activity have been basically swipe of a pen types of things. And the Trump administration and President Trump himself are very sensitive to economic activity, right? So they're watching data very closely. They know at what point in time the economy is about ready to break, and so I think they'll weigh and they'll measure that against reducing tariffs. Again, swipe of the pen removes tariffs in some sectors. Now,
Yeah.
their objective is to get reshoring taking place. They want manufacturing back in the US. And there's some industries that are so critical to national security that they're going to continue to keep that pressure on to make sure that they get reshored. But there are other areas where they can easily use a swipe of a pen to create exclusions. I know you and I talked a little bit in January at the Jumpstart conference about just the impact of those tariffs in 2018 and 2019 that were given exclusions. And about 35% of all the tariffs were granted exclusions at that time. And so I think ultimately, as we kind of get into the actual practice of applying these tariffs, I think they'll use that ability to weigh risk sector by sector, maybe product by product. And we'll see some backing off and we'll see some easing of these tariffs over time. So back to recession risk for a moment. I mean, I do see those estimates out there of a 30% recession risk. I don't know that it comes in the second half of the year. We would start to see the biggest impact in the credit markets and in the labor markets. And right now, at a macro level, those remain stable. So, soft landing, for instance, that may be the discussion, and that may be where we go, where we're looking at, annual GDP rates somewhere around 1% or maybe a little bit less through this transition period
Hmm.
before we build momentum coming out of the backside of it.
Okay, and that's really interesting. And you had just mentioned sector by sector tariffs. Obviously, we have auto. There's been a fair amount of attention on obviously steel and aluminum, which has already happened. We have pharma. We have semiconductors. When you look at tariffs or potential tariffs on that sector by sector basis, do certain things jump out to you in terms of potential impact? The tariffs on a certain sector could be impact consumers and by or businesses and by extension consumers more so than others? Or again, is it we have to kind of look at the fine print first?
Yeah, I think we're going to have to look at the fine print. The steel and aluminum tariffs, those actually created a lot of consternation in the business environment. Everything from construction to manufacturing, all the way across the board. But when you actually look at the relative cost per product, the product costs are not going up 25%. I mean, that particular input into those costs are going up by 25%. So a steel input is 25%, but it may only be 1% of the total product cost. So the actual impact at a macroeconomic perspective, again, is sort of mild inflation of, 0.3% or so. And we don't
Okay.
know how quickly US domestic production on some of those industries will fill in. What we worry about is where we don't have a US presence right now in an industry. If we're 100% sourcing a product overseas, like some of the medical pharma industry, it will take those supply chains a long time to be able to make the adjustment to build US domestic capacity. Those are the ones at the greatest risk. Right now, just for instance, Jeff, about 75 or 80% of hospital administrators are believing that they're going to have to increase healthcare costs to their patients because the ability for us to manufacture everything that we need to be able to fulfill the healthcare supply chain, we just don't have that capacity. And so those
Hmm.
are the areas where I would see those exclusions come pretty quickly. And that's indeed, I mean, that's what we saw in 2019. Those were the first industries that got exclusions. So, I think he'll stay hard and fast on some areas like pharmaceuticals. We can't run out of baby formula again. Some things like that I think have some national security bearing. He's going to stick hard on. I say he. It's all President Trump, right? It's between
Yeah.
his ears.
Yep.
Yeah, and so I really do think that there are some industries like that where he's probably not going to bend. But again, where we don't have domestic capacity today, I think that's where those exclusions will come in.
Okay. Understood. And I wanted to shift back real quick just to the whole USMCA component, Keith. Obviously, this has been a big topic. We saw tariffs on again, off again, et cetera, um, being levied on each of our tr North and South trading partners. How do you view sort of the current state of things? Where might things be going in terms of how we look at U.S. Trade and basic and really by trade relations in general with both Mexico and Canada?
Yeah, honestly, I've been kind of surprised at how hard the president has been on Canada and Mexico tariffs, and how sticky they have been. There's those 25% tariffs, and that's pretty significant, and it does impact a lot of industries. And so we were waiting, just keep waiting on him to back off on those. But it's not coming. And strategically, we need a strong USMCA block, if you will, to offset some of the foreign risks, some of the geopolitical risks to the United States. So from a military national security perspective, it has a lot of weight, and we need those two economies to be healthy in order to be able to create that stability. And so I've been a little bit surprised that we've been this sticky on applying some pretty heavy penalties on that cross-border trade. And so I would love to think that as we again get beyond April 2nd, that maybe there is some softening and some easing on some of the tension. But in the meantime, it really is creating some challenges. And again, we go back to automotive. automotive is one of the big areas that's going to take a big hit. And there's a lot of rethinking of, how we move products or what the impact would be. The average vehicle, price on it can range anywhere from, five to $10,000 per vehicle in price increases. And just based on the cross-border trade and the impact of what would be essentially Mexico tariffs. So I I see where we're going long term with it, but I do think the near term impact is going to be it's going to feel pretty significant, I think, if tariff rates stay at the levels they're at right now.
Yeah, no, absolutely. Let's shift from autos over to ocean vessels, if you will, Keith. The big a hot topic this week has been the hearings through the U.S. United Office of the United States Trade Representative in regards to push really a push focused on eventually domestic shipbuilding, but it comes with some big caveats in the form of some hefty tariffs, fees, fines, whatever you want to call them, for China origin vessels calling at U.S. ports. It was, I believe, between 1 and 1.5 million with some variables in there. Uh, that 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 those are no small. I mean, those are huge numbers, and the general consensus is that that could mean that global carriers start calling more only on the larger ports and bypass smaller ports, which really could throw a wrench in how U.S. ports are viewed. Not viewed, but I mean activity. Ports like Baltimore, Savannah, et cetera, they probably wouldn't get as much freight or cargo as obviously L.A., Long Beach, New York, et cetera. There's a lot going on there. Nothing's written in stone. It would be interesting to see what the USTR eventually does. What are you hearing? What are you seeing on that front?
Yeah, just as you said, and I think you captured it all very well, that there's a lot of pressure right now on the USTR, and I think the industry is doing a good job of at least painting the risk side of things. I think the administration will have to go back and relook at the overall plan, and I don't know if it means just simply that they back off on the size of the tax, which would be one approach to make it painful, but not so painful that companies completely change distribution patterns, and especially what you were talking about, short sea shipping, where we have a ship go make multiple docks or multiple ports of call. And right now, even we're even thinking about what happens between Chinese built vessels in the global trade lanes, and how much shifting do we see of capacity of that capacity, moving between Asia and like European trade lanes, and maybe having to see then European vessels shifting to US Asia trade lanes, and does that create a lack of capacity and really tighten and increase the cost of transportation between Asia US markets? And so there's big ripple effects that are kind of going around the globe. It's not just the short sea shipping issue and what happens to the individual ports, but I think basically, as you outlined very well, the risk to the port industry right now is pretty significant as the rule was written. So what we hope is happening is that this is the art of the deal, and that you start much higher than where you're willing to settle, and that the Trump administration came in high with this forecast. Get the comment period, get the public comments, hear the testimony, and then come back at it with a more moderate approach. Because I understand the strategic need to start to build out the U.S. shipbuilding industry. Forget the economics for a moment. Just from a national
Sure.
security perspective, it's a big deal. It's a big deal. And I think they are worried about future conflict and the ability to head off adversaries. And so there is a real need there to make a change. It's just to use a carrot or a stick. And I think that's kind of where we're at, is right now you're kind of hitting the shipping industry with a stick, trying to force it, whereas opposed to maybe when the dust settles, hopefully what we'll get is a little more moderate approach, and maybe a combination of carrot and stick approach to get U.S. shipbuilding growing.
Right. I mean, to put it mildly, if you've been looking at the submitted comments to the USTR, there has been a fair amount of pushback on this. And that I mean, I that certainly has to get the administration's attention and the USTR's attention as well. I like that point you made, that kind of aim high coming in and then see where the dust settles. It's something we're following closely. It's something the whole industry is following closely. So, the end result is gonna be really quite interesting to say the least.
It is, and it's broad based. You know, you've got the retail federation. You've got all kinds of industries that are impacted by this. So it's not just the port authorities, and it's not just carriers that are pushing back to say that hey, this could be really dangerous for the U.S. You know, it's all these associations that rely on that flow of goods, and they're all putting good data, good risk data in front of the administration, so they just understand the size of the risk and what they're doing.
Yeah, absolutely. Two more quick things before we wrap, Keith. And I just want to get your take on the recent deal with that BlackRock made. It was really an all-encompassing deal. They made a major investments in different ports and port terminals, if you will. But really, on each end of the Panama Canal, those are really the big ticket items, if you will, as it relates to the U.S. supply chain. And obviously, the Trump administration has been talking about how it wants to take back the canal and how China has too much of a presence there. A lot of moving parts again. And I don't want to get too inside baseball on it, but what's your take on all of it?
Yeah, so I got to participate in a national security roundtable recently, and from a military perspective, that's where I think a lot of the concern was being generated, ability to move ships between two different, the Atlantic theater and the Pacific theater, and that if we had a foreign country that has an adversarial relationship with the U.S., that wouldn't be good for potential movement of those military vessels. From a commercial perspective, when we think about it from a global supply chain and the commercial side of the world, the drought had a bigger impact on us than who owns the different gates on
Yeah.
the opposite ends of the of the actual Panama Canal. And the impacts of just not being able to move 35 ships a day or 36 ships a day through the canal, that was a crisis for us, and changed distribution patterns. But the actual ownership by BlackRock was a good compromise. It probably eliminates the fears that was driving some of that discussion. And so I hate to downplay it, but I feel like it's probably an event that's in the rearview mirror that we're looking
Yeah.
back at, and we
Okay.
probably shift our focus more to concerns about further drought and what that does to throughput.
Understood. That's a great take. And then lastly, Keith, I'd just be curious to see how you view, I mean, obviously it's still early. We're not even April quite yet, but prospects for the 2025 peak season. My expectation would be that it's going to be a little different just because of what's going on with tariffs and how that impacts planning and forecasting to a degree. Do you think it's going to be different, or do you think it's going to follow more typical patterns, or is it just too soon?
Okay, so I got to throw a weird curveball at you because I'm gonna bring out the conspiracy theorist in me, okay, and in a
Okay.
good way, in a good way. When you look at the Trump administration right now, they have a real need and a real desire to be hitting some economic momentum and to be hitting some strides by the second half of this year. You think about going into midterms next year, they need to have a lot of economic momentum built early in 2026. And so I think the pain, the suffering, the turmoil, the change, the transition, everything that we're going through right now is the administration trying to pack it all in the first 100 days or trying to pack it all into the first 6 months, to try to get all that change made so that business, economy, the consumers can all make their adjustments, and then we get into a different kind of growth pattern. And so that's a long way of saying that I feel like there are a lot of interests right now that would be creating tailwinds to make sure that we have a good, robust peak season with decent consumer spending, with again a fairly stable unemployment rate, even if it's up just a little bit, but that we still have good wage growth, and you start to see segments of the economy start to thrive. Because I think again, it would take right now an overestimation by the administration that what they're doing is all the right moves and none of the wrong moves. It would take that kind of an overestimation for them to really miss in a big way. setting up a better growth environment as we go into next year, because it's critical for the final 2 years of the Trump term that he hits that midterm with a lot of momentum built, and so I think they're going to do everything they can to make sure that happens. So anyway, that's my thinking. I think when I look at economic fundamentals right now, they generally remain pretty positive for a good, robust peak with what we would consider to be good consumer sell-through.
Okay.
Cons Consumer's still pretty healthy right now. Retail sales forecasts are still pretty good. We have to watch the role of inflation, have to, watch the role of Doge and some of the government layoffs, and if there's a ripple effect there. But most estimates are saying that those are going to be pretty isolated, literally like the DC area and a couple of other heavy government worker areas that go through some pain and suffering there. But the rest of the economy tends to do pretty well through that period. So anyway, it's still a lot will happen. As you and I were joking about off camera, we could do this podcast in 2 weeks and things may be different. But
No question about it. And a lot of it don't you think a lot of it comes back to the need for supply chain certainty as opposed to uncertainty, which is definitely being felt by a lot of people. And I just say that because we recently did here at Logistics Management, we recently did a survey focused on the current state of supply chain uncertainty, and it overwhelmingly came back to something like 91% are feeling the current impact of supply chain uncertainty. But that also speaks to what you're talking about now with the administration trying to juggle a lot of different balls in the air. So we'll see where it all ends up, right?
yeah, and I think you nailed it. When you think about corporate executives, you think about the stock market, they hate uncertainty. They don't even mind if you give them bad news as long as it's certain bad news, because then they can make
Yeah.
adjustments, right? They can make adjustments, they can deal with it, they can work through it. What they can't handle is the uncertainty. And right now that's what they've got. We've got a lot of uncertainty out there. We see consumer sentiment has dropped a little bit, and that's delayed spending. But as soon as we get into a certain environment where they know exactly what their tariff risk is, then they can start to work plans to get around that, or they can work through it. And I think that's what the stock market's looking for. I think that's what the corporate world's looking for. So the sooner that the administration can kind of get to that point, obviously, I think the better for everyone. And that would be my only real gripe with what's happened over the first 100 days, is just that there's a lot of volatility and uncertainty, and that has slowed down some of the momentum I think that could have already been built.
Yeah, understood. All right, look, Keith, this brings us to the end of our time for today's podcast. So, on behalf of Logistics Management Magazine and the Peerless Media Supply Chain Group, I'd like to offer a big thanks for spending some time with us today.
Oh, absolutely. It's my pleasure, my honor. Yeah.
Yeah, thanks again. And for those of you listening in, if you want to learn a bit more about Armada Corporate Intelligence, please go ahead and check out their website. It's armadaintel.com. And Keith is also on LinkedIn. So if you want to go connect with Keith, go find him there. And his last name is spelled Prather. And for those of you on Twitter, please go ahead and feel free to give us a follow simply at logisticsmgmt. And also, if you're not subscribed to our podcast, please go ahead and do so. All you need to do is punch up Supply Chain 24/7 podcast wherever you get your podcast, and it'll be right there. And please go ahead and subscribe. Thanks, everyone, and we'll catch you next time. Have a great day.